Okay, well, let's find out what you do like and what you are adding to. It's time for Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick, and kudos to you because you picked it before quarterly results came out. And you're still sticking with it.
Unfortunately, I owned it before quarterly results came out.
Yeah, and you're sticking with it because post-quarterly results, Fiserv is down 17% on my screen right now. You've had a few moments with the quarter. I know you haven't been able to go in depth. But basically the outlook, market didn't like the outlook that it provided. It's a fintech. So maybe let's start with the ABCs. Like, what does it do? Sure. What do you like? Well, then we'll talk about the myths, and then we'll talk about why you'd buy it.
So they've got a couple businesses. First, on the banking side, you go into your bank, you make a deposit, you write a check, you want to transfer money. The technology that banks use, their core banking technology, that's one of their divisions. Very sticky business. There's a handful of banks in Canada, but there are thousands in the US. They're a major player in that. And once you have a bank customer, you're not going to want to switch out your banking software very often. It doesn't grow very fast, but it's a good business. High margins, very sticky. Also, those banks issue credit cards. They handle the credit card issuing part of the business for them. The switching, connecting to the networks. The other side of the business is merchant acquiring. So if you go into a merchant and you go to Starbucks, you tap your card, that merchant has to connect to Visa. They have to get a bank to connect them to the system. That's called merchant acquiring. And that's the other part of their business. And so if you've ever seen some of the terminals, Clover terminals at restaurants, that's their product. Clover's been a very good growing sector for them. So the business generally does 30% operating margins, very good margins. They have delivered double-digit earnings growth for 40 years in a row. Based on their guide as of this morning's press release, this is going to be 41, I believe. They're guiding to, I think, about 15% revenue or earnings per share growth this year and 10% revenue growth. So I looked at the quarter this morning, and I've owned this stock for a long time. We bought it south of $100. It went to $220, $230, and now it's, I think, probably $130 today where it's trading. So, we've held it throughout that entire period of time. And at 220, the market probably got ahead of itself and it was in love with the stock. Now the market hates it. Mm-hmm. And so the bear case for the company is, well, Clover is slowing. Their transaction volumes, which used to grow double digit, are only growing 8%. But that division is still generating 30% revenue growth. They're selling hardware. They're selling value-added services. When I looked at the quarter this morning, my analyst and I talked about it. We thought it was fine. There were a few things in there, like the revenue growth definitely slowed a little bit. They gave away a little bit of margin.
Specifically in that merchant side of the business. Right.
And so management was asked about that. I think they're having to invest a little bit more in that. But going back 2-3 months, we compared their competitors to see, are they losing share? If they're losing share, I'm a little more concerned. But we saw a slowdown throughout the sector. So I think part of it is just the consumer slowing down their spending. And again, the number of transactions that are done will drive revenue in that sector.
And to your point about getting these banking customers and clients, they bought a part of TD's merchant processing unit, which I think is really just, it gives them, that's a new customer, right?
It's scale.
In TD, that's scale. And so is that material?
We don't think it's material. I glanced at it, Amber. It just came out this morning. I think it'll be less than 10% increase to that segment of their business. But again, it just shows that it's a tough business. You have to continually win business when a contract comes up. Competitors are in your face. It's a brutally competitive business. To win, you got to have scale. They're one of the biggest in the world.
It's also a good example of just because you own a value stock doesn't mean it can't drop 20% in a day.
It can drop 50%.
It can drop 50%.
So
it shouldn't happen as often.
But it does. So the efficient market hypothesis, the market doesn't always get it right. It often gets it right, but you don't get an opportunity to buy great businesses at a decent price. So we looked at the bear case, and again, I'm going to go back to the office and read the transcript. But I talked about it with my colleague for half an hour this morning, and we had a different view. It didn't surprise us that the stock was off. We thought maybe it'd be off a few percent, 20%, and where it's trading today, again, high level, a business that has delivered double-digit earnings per share growth for 40 years. And even their guide this morning means it'll be 41. That business shouldn't trade at 12 or 13 times earnings. The company is buying back $2.5 billion worth of stock a quarter. Management is telling you what they think of the market price, and the market disagrees. So in time, someone will be proven right. It's
also a new CEO. Like, does that create anxieties?
I think it does. We talked about that this morning. I said that Frank Bisignan, I'm not going to get the name right. The prior CEO was invited to join the Trump administration, which he did. The new CEO has been in the chair less than a year. He is not going to get. He is not going to have the same benefit. Get the same benefit of the doubt from the street, and so that could be part of it. And he has to prove himself to be credible and all that. But the business and their culture, I take a lot of comfort in that. And I don't think the business is unraveling. The market seems to be saying that the business is unraveling, and I disagree.
So you'd feel comfortable stepping in?
Oh yeah.
All right. We love that. This is right up my alley. I love that stuff. Okay, let's talk about your second pick, which is Icon PLC. The ticker is ICLR, trades in the U.S. as well. It's, what is it, Global Pharmaceutical?
It's a contract resource organization, or CRO. They service the pharmaceutical industry.
Okay.
So when before a drug comes to market, if you're a Pfizer or you're a Merck, you have to go through clinical trials, both to assuage the regulators in Canada, the US, Europe, that your drug is safe, that it's effective, and that it's better than something that's on the market. So their job is to run clinical trials for companies. If you're a small biotech or a mid-sized company, maybe you haven't been through a clinical trial and you don't know the procedures, how to deal with the regulators, how to create your submission. You have no choice but to use one of these CROs. If you're a mid-sized company, maybe you do a little bit in-house, but you tend to outsource a lot of it. If you're a big pharma, you're going to do a lot of it in-house, but you're also going to outsource because these businesses, because they work for everybody in the industry, they have global scale. And so I can run a global trial at our facilities. In addition, they tend to have very deep expertise in certain segments, whether it's stem cells therapy. And so big companies like Pfizer or Merck will outsource a portion of their business to these companies. So you need to be big, and the industry has consolidated over time where there's three major players, IQVIA or IQVIA, MedPace, and the third one is Icon. Two of them reported yesterday. Icon reports after the close tonight before this airs. MedPace was up 50% yesterday. I think IQVIA was up in the teens, and ICLR, Icon was probably up 10%. It's trading on 12 times earnings. It's got a good track record.
Well, let's talk about why, like when you get a big bounce like that, usually it's because the stock has been a dog.
Yes.
And so ICLR has been a dog. So that you explain why you like it. Why has it underperformed?
We bought it within the last 6 months. And
so
where the stock, well, we were following it. We liked the industry, and it finally got to a price where we thought it was attractive. We bought early. It's gone lower, and we're probably down, 10%, give or take. Why is it a dog? So the U.S. administration in particular, look, their Secretary of Health is a vaccine skeptic, Kennedy, right? He's hostile to traditional medicine. Our bet is this too shall pass. Science will win. You get measles outbreaks, people will realize, well, maybe we should vaccinate our kids. And every medicine has a side effect. So the skeptics will play up on that. Over time, research and development in pharmaceuticals has increased almost every single year over a long period of time. If that trend continues and the CROs continue to get their fair share of that spend, these businesses will continue to grow. And so when we looked at the space, we didn't care as much for MedPace. I think it's a good business, but they focus more on the really small micro-cap biotechs. And so that's a more volatile business because it's related to funding. IQVIA is best of breed, but the company is levered, which we didn't care much for, and it was on a relative basis, it was more expensive. We thought Icon, we really like their management team. They're cheap. They're good capital allocators. And I thought they had a really good business. They've got a good balance between contracts with large manufacturers, mid-cap and small. So I think it'll be more stable going forward. And today I think it's around 12 times earnings. They earned $14 last year. This year, the consensus before the quarter was $13.20. A business of that quality, if the business isn't broken, shouldn't be trading there.
Well, that's interesting that this is an opportunity to take advantage of a nervousness in the market. Because if there's no vaccine, or if vaccine development slows or vaccine approval slows, then why do you need clinical trials? So then their business slows. Do you see their business slowing, or does it already price in the business slowing?
So the last quarter and their competitors cited an increasing number of delayed trials and canceled trials. And I think that was a direct impact from the Trump administration and the uncertainty. If I'm a drug company and I want to submit something to the Food and Drug Administration, if they're making major changes, I want to wait a few months to see how it's going to shake out before I commit capital, because drug trials are very expensive. So I don't know what's going to happen in the next month or two. Again, Amber, I'm making a long-term bet that I don't think new drugs are going to stop coming to market. I don't think drug research is going to decline over the long term. So markets get schizophrenic. They get really excited at times over things that don't make any sense, like Open Door trading where it is, because it's a meme stock. And then some businesses, the narrative just gets ugly. Now, fundamentally, and that's when they get cheap. Our job as value investors to determine, is it broken? Is it a value trap? If the business is broken, then it's a value trap. But if the historical trend is set to continue, then we have a different view of the market, and that's when you buy. I'm buying things when they're hated. And oftentimes the market is right. I look at a lot of stocks that sell, I love cliffs where the stock sells off 30, 40, 50%. I run towards it. Most of the time, I can't get there. I think the market is right. Something's happening in the business and it should be cheaper. It was either too expensive. The business has materially declined in terms of its future profitability. But once in a while, it's wrong. And that's when we make bets. All
right. Well, we found two of those potentially in Icon and Fiserv. Your third one, probably less of a household name, an Israeli-based company called Automated Bank Services. And honestly, the chart isn't as ugly as some of the other charts. But it's not it's still down around 8% so far in 2025. What's the business? What do you like here?
Yeah, the business in the community is known as by its ticker SHVA, which is SHVA. That's what we call it.
Okay.
I'm a payments nerd, and I had never heard of this business. They are the Visa of Israel. They run the payment network for the entire country. I was in a conference in Switzerland. Somebody from Israel said, you should look at this business. And so I did. It's hard because it's a market cap. At the time we bought it, it was 150. Today it's about 300. It's a small market cap. If you know the history of Visa and MasterCard, they were originally started and then owned by a consortium of banks and then spun out. And now Visa and MasterCard have become better businesses than the banks they were spun out for. What's happening, I see the same roadmap in Israel. The government it was originally owned by the banks. The government wanted to create competition. So they said to the banks, you can no longer own more than 10% of the business. No person can own more than 10%. So the four banks did an IPO to sell their stake down to 40%. Visa and MasterCard was encouraged to come into the market and compete. And they said, no, thank you. The network is already established. So they each bought the maximum, 10% each. They're shareholders.
They bought
They bought 10% each before the IPO from the banks that had to divest.
Yeah.
So you've got a company today with, I think, about a $300 million market cap, and 60% of the float is owned by 6 people. And so it's not a very well-known name. Again, I'm into payments and I had never heard of it. And their financial statements come out in Hebrew originally. The management has done a good job of getting them into English. It's a little bit delayed. So it's work to actually get to understand this business and the company. And you can be a small player like GreensKeeper, and I can play in these places. Buffett and a manager that's managing billions of dollars can't. And so when we looked at it, at the time we bought it, it was trading on 12 times earnings net of the cash. Again, incredible margins, high 30% operating margins. I think they got 150 million shekels on the balance sheet, no debt, just an amazing business. And they were going through this tough period where they were separating from a sister company. Again, the government's forcing them to do this. They're having to spend more money to build systems, to reinforce their infrastructure because of some of the cyber attacks they've received. So, you've seen margins come down a little bit. When we bought the business, at 12 times earnings, I think the stock was at 14 shekels. It went to almost 29. It's come back to 22. We think it's modestly undervalued today. I'm not pounding the table here. I think it's modestly undervalued. We're not adding to it, but if it goes, there's a price at which if it gets to it, we're going to reload.
When you've got 6 owners who own about 60% of the business, do you have to be worried about selling, like them just constantly selling, or you think they're strong hands? They'll keep a chunk of the business.
Well, I'll speak first to Visa and MasterCard. I mean, it's a rounding error, $10 million to these businesses. They're buying it for strategic reasons. They want to be tied to this business because internationally, SHVA just runs the network, the monopoly network in the country. As they go internationally, Visa wants them to use their network or MasterCard. The banks are the biggest customer of the business. They want to continue to have board seats, to have influence. The biggest lever the company has to improve the profitability is taking price. If you look at what they charge their customers relative to what Visa and MasterCard internationally does, it's like 4 to 6 times cheaper. So they've got a ton of pricing power. And our bet is over time, management is going to increase prices in that business. Again, this was like a government, quasi-government. It was owned by the banks, but they ran it like a utility. There's no market pressure to increase margins to make the business grow. Now that it's public, they took price 2 years ago for the first time in 10 years. They raised their prices. And again, they're still way off of where the market is. So our view is transaction volume in Israel will continue to grow. They also run the ATM network. They're a monopoly there. Peter Thiel once said that like competition's for losers. Monopolies are great businesses because you've got pricing power. Now the regulator, you got to keep them happy. You got to keep your customers happy. But Visa and MasterCard have shown that over time, they can take price almost every year. And that makes for a great business. And you take price with a business today that's not operating on all cylinders, and it's still doing 30, 40% margins.
All right. I love this under the radar pick. Thank you so much, Michael McCloskey. I've learned a lot in this episode. Thanks for joining me.